Hello and welcome to the DIY Investing YouTube channel. We're working through every company in the S&P 500, and today is CVS Health Corporation, ticker CVS. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. The market cap is $130 billion, enterprise value $166 billion. So you have about $36 billion in debt leverage on this business. It is a healthcare provider and services industry. CVS Health provides health services. I believe this is retail locations. Yes, it has 9,900 retail locations and 1,200 Minute Clinic locations. So retail sells prescription over-the-counter drugs, human self-beauty products, and the Minute Clinic provides walk-in medical services. So something to think about of what they are. Very large retail organization here. Retail tends to be a lower quality business in the United States, but it depends upon what they're doing. The beta is 0.739, which is relatively low. It tends to suggest a more stable business. Stability tends to suggest higher quality. So something to think about as we dive on further. So return on invested capital is a really useful metric. I like to see 19 or 20 years of profitability for a high quality business. And from what I see here is they have 19 years of profitability. So 20-year period, you have only 1 year of losses. That meets the metric for a high quality business under my threshold. However, a quick look at the chart just shows that it's declining over time. I don't really like the fact that return on invested capital has declined for most of the last 20 years, although really it's declined from 2003 down to 2008, and then it kind of stabilized and recovered a bit up until 2017. However, since 2016, 2017, it has been quite poor. Returns in 2018 were negative, and then 2019, 2020, and 2021 were 4 or 5%. That's not very good. Now, when we think about this, though, these returns are not very good, but you get up to that 9% range, you start to getting closer to acceptable. So one of the things we think about here is these numbers are low, but they are stable. I like stability. The more stable it is, the better the business tends to be. However, the returns on capital are going to limit your ability to have high returns. If you think about an 8% return on invested capital, 11% return on equity, it's going to be very difficult to get a higher return for shareholders than your return on invested capital or your return on equity. Now, the reason this return on equity number is bigger, of course, is that debt leverage, but it's not meeting the 15% threshold I like to see. It's not meeting the 10% threshold I like to see return on invested capital. And when you think about that the recent history is worse than the past, worse than the 10-year median, it suggests to me that the future could be substantially worse. So I'm not excited on the quality of this business. The stability is a good sign, but stability alone is insufficient. We'd like it to be above this 10% line. And you can see they have only been above that 10% line for 1 year in the last 15 years. And so that's just not meeting the threshold I'd like to see from a quality standpoint. In addition, this company has an above average price. Average price historically for the S&P 500 companies is 15 PE. Yes, it's trading at a 16 PE. So you're paying an above average price, but approximately average, for a lower quality business. That's not something that's super exciting. Now, why is it trading at that price? Probably because you have high revenue growth. Now, you have 10% revenue growth. However, assets are growing faster than revenue and faster than earnings, and so that's part of the reason why you see this decline in returns over time is you're growing your assets so quickly that you're not getting the return you need from earnings from that. And the only reason you're able to make that up is because you're continuously probably raising debt, and when we get to the balance sheet, that's one of the things we will look at. Another thing to think about is the gross profit margins in this business are relatively low. There's not a lot of room here to grow, and you clearly don't have pricing power, but they have been growing revenue pretty quickly. You can see they've more than doubled from $123 billion to $292 billion over the last decade, so they are growing quite quickly there. But I have a feeling they're going to either be diluting shareholders and raising debt, or at least raising debt in order to do that because the returns simply don't allow them to reach this growth rate on their own. Something that is definitely a concern for you as a shareholder. So probably a high price to pay and probably a poor business, but maybe an average business that you would see with this investment. So Again, EPS is nearly doubled, $3 per share to $6 per share. Pretty good growth over time. They've tripled their dividend from 65 cents per share to $2 per share. But you can see over the past 5 years, it's basically flat. And I mean, they haven't grown their earnings since 2017. 2017, they're at $6.44. They're actually below that today. So flat dividends because they've been unable to grow the business over the last 5 years. That is a concern for you as a shareholder. That's despite the fact that they've grown their revenue over 50%. So they've grown their revenue 50%, and yet earnings are negative for 5 years. Not exciting thing to see. So I would definitely be concerned there as a shareholder. So if you're enjoying this video so far, please hit that like button. Don't forget to subscribe. If you ring that bell, you can get notified as I upload new videos Monday, Wednesday, Friday, each and every week, covering different stocks. I've already covered more than 120 S&P 500 companies, and I have a playlist for you at the end of this video where you can watch the full list of my backlog of S&P 500 companies. So income statement. Let's see. Operating expenses growing quite quickly, but again, they have been growing their business, so that's not super surprising. What I want to see here, so their loss in 2018 was due to tax effects. And so you don't normally pay higher taxes than you earn in pre-tax income, which to me means that this number is actually fake. They actually earned money in this year. So they've earned profits for 20 straight years. It's not 19. This is actually a non-operating loss. So I'm actually okay with that. That makes their quality look even better than what it did. And again, that's because this 2,000 income tax number is bigger than the pre-tax income. So it's a one-time effect. It's probably an impact of partially, at least, due to the 2017 tax bill. And then they have some other non-operating income here. So maybe some write-off. Now, what's interesting is you had some buybacks, it looks like, over the course of the first 5 years of this decade. And then it looks like they've grown the shares outstanding over the last 5 years. So they they had a 30% dilution in 2018. That looks really poor for this business. And that's causing a relatively poor return for shareholders. And it's also why your earnings per share has peaked, because you've grown your net income from $6.6 billion to $8 billion, and yet you've not been able to match this EPS because you had to dilute yourself by 30%. That's a very bad sign for shareholders. Balance sheet. Inventory's up by 70%. Goodwill has grown massively, $50 billion. PP&E has grown massively, 4x over the last decade. I mean, this is the problem. You 4x your property, plant, and equipment. And yet, what do we say the earnings have gone up? You've doubled your earnings and you've 4x your assets. Really, really bad. You don't like to see that. In addition, that understates it because there's a massive acquisition here in 2018 that's causing this big boost. And so, I mean, it doubled your assets, and yet you had to dilute your shareholders by 30%, and you've still not returned to your pre-acquisition earnings per share. Very bad acquisition and capital allocation here. If the management's the same, this change from 2017 to 2018, without even knowing what the acquisition is, this would make me want to avoid the business. It just doesn't look good. They added $50 billion in debt. It looks like they've been working really hard to pay off that debt during that time, paying off $20 billion in debt over the last few years. But I mean, think about this. You've gone from $9 billion in debt to $51 billion in debt over the last decade. And yet you've only doubled your earnings per share, but you've had to 5x your debt. You're set up for a very poor returning future, especially as you think about the fact that interest rates are rising. This is just not a business I would be interested in owning. Let's look at our cash flow. You have pretty steady stock-based compensation that's causing some of this dilution, and then you've been unable to buy back stock for 4 years. That's why your shareholder returns are getting worse. They had to issue $38 billion in debt, $40 billion in acquisitions. In addition, they had to dilute shareholders as well. Very poor setup for your future returns if they were to do something like this. Now, can they do it again? Probably unlikely, but there certainly just shows the way that they think about shareholders. You can see it also marked a change where there's massive more stock-based compensation. I mean, it's $500 million in stock-based compensation per year. So that's a significant amount of the business being given to management, and they're not buying it back. So for me, this is a company that I would avoid. I'm not going to invest in CVS Health. It doesn't go on my watch list. Despite the fact that they have 20 straight years of profitability, the returns on capital are just too low. Earning 5% return on invested capital means that if I hold the company for the long term, I shouldn't expect returns higher than 5%. Maybe I get the return on equity of 11% here, but that's if they're reinvesting completely and they're not diluting me and they're not raising debt and they're doing all those things. And then you have interest rates rising. You have massive dilution here. I have hesitance about the capital allocation. To me, this is just not a stock worth owning for my portfolio. So it won't go on my watch list and it will go into the queue. So if you enjoyed this video, please hit the like button. Don't forget to subscribe. Ring that bell so you can get notified as I upload new videos each and every week. Don't forget about the playlist here at the end of the video for all the 120 plus S&P 500 companies that I had already covered, and we are on track to do all 500. So stick around. Let's work through every company in the S&P 500. If you like this software, if you want to be able to look companies like this, look at these 10-year histories, look at all these overviews very quickly, very simply, just like I do, 5-10 minutes, you can study a company and make an analysis, then consider joining quickfs.net. Please use my affiliate link right in the description. It's the first link in the description that would allow you to sign up for a free or a paid account. And if you sign up through my link, then you would be supporting my YouTube channel because I would get a cut of the commission from that. So please consider joining quickfs.net using my affiliate link below. Thank you for listening, and until next time, stop paying fees, start building wealth.